Well, hello everybody. This is Brandon with Crypto Trades and Tech. It's been a bit since I was able to do a video. I apologize, but today we're going to talk about a few things that's going on with this Bitcoin sell-off, crypto sell-off, my thoughts and my apologies. I put out a video a couple of weeks ago calling for 72K for continuation off of an uptrend area we were watching, looking for support to hold there. It broke through. And so we're going to talk about what that means and what my outlook is looking forward now that my invalidation levels have been hit a while ago. Before we continue, as usual, if you end up taking my advice without doing your own research, you're going to end up living in a van down by the river. Now, if you're still invested in crypto like I am, it probably feels like you should probably start researching riverfront properties, looking for vans, especially if you're holding a lot of UST or Luna, and I'll kind of share my thoughts on that whole meltdown and what that might mean for the crypto industry moving forward as well. But what I want to start with is back here on May 8th, I did have a specific invalidation level. That was $34,300 was my invalidation level for that $72,000 call. And as soon as we hit that, I put this tweet out that I clearly underestimated the capitulation move. And this has now plunged us into the final part of this bear phase. My thesis was that we had this rolling top, accumulation bottom, another rolling top, and I was looking for another accumulation. And what we've done instead is that ascending channel was a redistribution event, and we've sold off now, and we're now in a new accumulation. Now you can see here, I tweeted this out at 34, price was 34,400 roughly, right around the time I tweeted this out. And it went ahead and sold off all the way down below the next area we were watching, down to 26,000. So that is bad news. That generally speaking, we're now looking for lower prices for an extended period of time. What I want to really highlight here is a couple of things. One of the reasons I haven't done a video recently is I've been reconfiguring a lot of my rules. So I have a trading system and a trading plan, and I put a little bit too much emphasis on fundamentals, clearly, and I've been reweighting what fundamentals, how much they mean, and over what time frame they mean what they mean to me. And so that's helped me to have clarity moving forward as to what I'm going to do with the next few steps that I anticipate. Let's go take a look at the chart here and just look at a few things. I'm going to zoom all the way out to the weekly level. So my current target accumulation range, now I do think that if you're bullish and you want to do some DCA, this is a fantastic time to resume your DCA activities. I am saving some funds for the low, this wick low that we just put in here, 25,003. I do believe that we will retest that low at this point. And we have a CME gap. I don't have it on this chart. The CME gap starts right around 24,600, I believe. But obviously, no, it started around 26,000, goes down to 24,000. We've closed a part of that gap. What I'm looking for is the remainder of the gap to close. And then for us to go ahead and hit the 200-week moving average, which is currently this blue line here, a 200-week moving average at $22,000. My anticipation is that given this downward momentum and the levels that we've broken down from, that we will go ahead and hit that level before any resumption. It doesn't mean it's a guarantee. This market cycle has been quite different, and we might not get a capitulation that low, but that's my expectation. So the next thing to look at here is when are we safe to try to start picking up some resumption of the upside trades. And at this point, one of the things that has really stood out to me is, had I followed my rules a little more closely, or really, I did follow my rules largely. We didn't get a good chance here to sell the 50-day moving average. I should have sold right here, that 50-day moving average. I should have sold more spot right there, but at the time, I personally was on vacation, and I thought it was going to come revisit that again before rolling over more substantially. But I was wrong. It rolled over very quickly, and it really hugged the 20-day moving average on the way down. So I've added the 20. If you notice, you'll start seeing the 20 on my chart, just because in this situation, I noticed we had a lot of price action around the 20 before it rolled over, and then we came back into the 20 instead of the 50 and found that as resistance. But here again, I did get defensive at 48,000, right? I took a lot of profits, and then I took some stop losses trying to buy support around these areas over here. We rotated back out largely at 42,000. and then I tried to buy the support area at 37, 39 to 37, and then when this little pop-up happened and then we rolled over, I got out at break even again, largely on those orders, and then we tried again right at this trend line at 35,000, and I'm still holding those purchases on the way down. So I've personally bought back in at right around 35,000 right before this wick low. See if we got a bounce right off that trend line, and then between 31 and 29,000. Now I'm still saving funds myself for as far down as $20,000. I removed all the drawings today, but the $20,000 mark is simply the prior all-time high, of course. And the CME all-time high was 20,000. So when the CME futures launched, let's go look at the CME chart 1 second. Here's that CME chart. Now, a lot of people are going to be looking for a test of the prior all-time high, which was just under 20,000 on most data feeds. It was 19,800 or so. But when the CME futures actually launched in early 2018, the CME futures launched at 20,650. So that will actually be my target, kind of a little bit front running the 19,000 level for the last of my limit orders. Should we revisit these lower levels? So again, the 200-week moving average is where I will be pretty heavily back in down to the 20,650 level, and then at that point I'll be fully back in with any stable coins that I'm holding currently. But then for trades coming back out of this, I'm not looking to place any trades anymore. I did try to take a breakout trade to see if we could ride a move to close this gap right here. So we do have a gap just on, again, back to the CME futures chart. We do have a gap right here at 35,000 roughly, but I thought we were going to head there sooner rather than later. I'm not 100% sure. You see we have some market structure here that we're putting in. Should we get a break to the upside of this market structure, it may be worth a counter trend play. It's not something I'm too excited to try to take advantage of. It's only if it's super apparent will I try to put another entry on. I did try to take an entry on the first breakout of this. It rolled back over. It got a good pop, but then it rolled back over. So that's the next level. We'll see if the market wants to retest to close this gap before testing these bottom levels. It's kind of my expectation, since we got this pretty immediate rejection right around 32,000, that we're going to go ahead and consolidate in this area, test this area, and then eventually close that gap. The other part of this is a lot of people are looking at the 4-year cycle, looking for a bottom as far out as the end of the year. I am optimistic that we will bottom faster than that because of just the nature of the rolling tops, rolling bottoms again. I would anticipate that we may still come into higher prices than many people. So when we do come down, if we do roll back over, right, and retest 20,000, 21,000, 22,000, there are going to be a lot of people calling for this gap right below it to close at 18,000, and then even, there's going to be people calling for 10,000 at that point. It's going to be super bearish looking chart. Given the very strong accumulation behavior that we've seen, I'm going to continue to be less inclined to look for further downside for too long. So I think the worst case target many people are looking at is possibly like the 2019 swing high over here of 14,000 or so. I know a lot of people are considering this one a potential kind of worst case target, and I would too. I think it's not obviously impossible that we go ahead and even hit that level, but I'm optimistic that we will hold this about $20,000 level again, given the strong accumulation that we've seen. If this is the first kind of phase, so if you were to take a fractal of the summer activity, this was a redistribution. So we had a distribution and then a redistribution over here, pretty clear. And if we take a fractal of this, you can see us getting down as low as, right into the mid upper 20s, not even hitting this $20,000 level. At this point, so again, I will go ahead and layer in orders and be fully back in at 20,650 because I do think there's a really strong chance we get a really strong bounce off of that. But if we don't get all the way down to 20,650, which would be my bottom limit order, then I will be waiting for a break of this trend line and to take the 50-day, at least the 50-day and the 111-day moving averages, which should hopefully be down pretty close to that level by about right around that trend line. But that's the main trend line I'm watching, right? So should we Should we bounce off of, say, 23,000 and I don't get most of my limit orders filled, then I will simply wait for resumption. Once we retake, you can see the 111 looks like it's going to be tracking this pretty closely here, and the 50 is going to be just below it. So should we get an event where price kind of bottoms out, the 50 curls up under here, the 111's here, and price comes back out of here, when price starts to retake all these levels, that's where I'll start to look to take trades off of. Once we've kind of reestablished a new uptrend, or pretty clearly on counter trend, then I'll look at these support levels wherever we broke right out through here, and I'll look to buy into those horizontal support levels. All right, the big news of the week is clearly this Terra meltdown, the algorithmic stablecoin breakdown, and I was taken back by the speed at which this actually collapsed. My expectation was that the reserves that they had built up in Bitcoin would be enough for them to restore the tether peg initially, and then once those reserves had been well drained, as people continue to exit the platform in fear over a longer period of time, say weeks or months, then it would again start to lose its peg and then really be open to an attack. I didn't expect the avalanche nature at which the meltdown happened. So this just highlights the dangers of these algorithmic stablecoins and how difficult it is going to be to make one work. Collateralized stablecoins like USDT, USDC, or Gemini USD are obviously a lot safer compared to these algorithmic stablecoins because they just don't have the same inherent risk of the parent token losing its value and then causing this death spiral. The collateralized assets, generally speaking, if they're backed properly and audited, should be enough to maintain the peg of an asset. Now, the other big part of it is, this is why I've never kept funds in Tether for very long, is I don't know, I haven't seen clear auditing of their reserves to know for a fact they have enough liquid assets to continuously prop up that peg against a prolonged sell-off and weakness. So I do consider USDT a little bit vulnerable to attack. For me, if I'm going to hold on to stable coins long term, I use Gemini USD first of all. Generally speaking, Gemini is my main exchange for spot trading, and I will park my Gemini USD on their earn platform typically. It doesn't have the highest payout, but it is, in my opinion, the safest of the yield generating centralized platforms. Otherwise, on other platforms that don't support Gemini USD, I will hold my stablecoins in USDC. You can see the Circle has partnered with a massive firm, BNY Mellon, who's also the firm that's handling the grayscale conversion to a Bitcoin ETF. USDC reserves will be custodied with them. Now, there's always risks, but I feel far more comfortable holding a stablecoin with assets custody by a large Wall Street institution. We know that there's good regulation and oversight of relatively speaking of these facilities. So if I'm going to hold a large stablecoin, it's going to be USDC, again outside of Gemini USD. Now here's why I prefer Gemini USD. Here's the Gemini dollar 1-to-1 backed collateralized stablecoin, and I'm just going to read you their statement. Right, Gemini is a U.S. company regulated by the New York State Department of Finance Services. Each USD corresponds to US dollar held by Gemini accounts and the US FDIC insured bank accounts and money market funds holding short-term US Treasury bonds and is maintained at custodian. The cash portion of the GUSD reserves may be eligible for FDIC pass-through insurance for Gemini customers. Audits of the reserves are published monthly by an independent registered accounting firm, BPM LLC. The Ethereum smart contract is audited as well. So if you're going to hold a stable coin, it doesn't get much safer than this one. All right, well, thank you everybody for hanging out today. Everybody, of course, always use good risk management. I did put a little tweet out just encouraging people to look at a couple of different methods of risk management. Diversification is one form, but being in quality names, as of right now, let's just to close, again, I think if you are bullish on Bitcoin, really ramping up your DCA activities here is not the worst thing you could be doing. You can see Bitcoin dominance is peaking a little bit here. Frankly, the most stable coin is Bitcoin, and it's I know it's a silly thing to say. It's not obviously clearly a stable coin that's pegged to the US dollar, but it is stable in the aspect that if you have a long time horizon and you want to be invested in crypto, but you don't want to have to worry about all the huge risks associated with many altcoins and DeFi projects, if you keep a portion of your investments locked up in Bitcoin, especially if you hold it offline, or you have some of it on a very reputable exchange for trading purposes, that's going to be your safest mechanism to get exposure to the crypto space. Again, it's best to hold Bitcoin offline for a long period of time. And if you do nothing else but buy when Bitcoin is well below the 200-day moving average, and especially as it's coming into the 200-week moving average, you can see here, we are in this is a 200-week moving average heat map. I love to refer to this. If you're trying to be a super simple about your trading style, buying when this is close to the 200-week moving average and DCAing more aggressively, saving some funds for a touch of the 200-week moving average, and selling when the chart starts to show that it's overheated. Now, of course, we talked about I didn't sell nearly as much as I would have because we never really reached any sort of parabolic fervor in November. I did a much better job of selling a good chunk, especially my altcoins, on this move. You can see here, it was both fundamentals and technicals were very far detached, very overbought, but not to the level that we'd had in the past. November was a little bit more difficult because it didn't look nearly as overbought on many metrics. Derivatives kind of led the way there. But nonetheless, if we start to DCA back in here, it may not touch the 200-week moving average. It's the other thing. Again, you look at this, you see the red dots, and then the capitulation move on the other side is down at the 200-week moving average, even for an extended period of time. We may get either less time at the 200-week moving average, or we may not touch it exactly at all. My expectation, again, is clearly that we're going to. But so much has been different this cycle. The other, to me, in my opinion, fairly safe way to play this is to wait for price to break this trend line and to retake the 50 and the 111-day moving averages to start really being more aggressive about long trades. Until then, this is really, and if you're into shorting, this is where you want to be shorting the market, in my opinion. But the 200-day moving average, as it comes down, when you retake all three of those, that's when it's really safe to look at being more aggressive with your long trades. But the safest possible way to play this market is, again, just to DCA in. As we get closer to this 200-week moving average, the DCA activity is even safer. So the more aggressive you are as we wind down here, we find ourselves down, at the peak sell-off later this year, and then a recovery into late this year, early next year. It's kind of my general expectation right now. I think you're going to avoid a lot of heartache by just DCAing in, leaving funds. Either you can fully buy in at a point, pick your point, be fully back in, or you can wait for resumption off of this outer trend line. I'll share with you what I'm doing as well. I said early on that I was going to be fully back in with my current stablecoin stash at right around the $20,000, slightly above this at that CME gap, or right around 21,000. That's because I'm very bullish on Bitcoin long term, and I like the fundamentals, and I want to pick up as much as I can. However, I also do have funds that I'm bringing back into crypto that I had pulled off. So in the summertime move, I had gotten completely taken my initial investment completely offline. What I'm looking to do is to be fully invested with my current stack of stablecoins in this area, and then to use those funds that I had taken off of crypto to play a breakout and try to ride this next move, and then quickly, as we come into resistance, take those funds back offline. But I do feel pretty safe waiting for resumption. All three of these moving averages, the 50, the 111, or the 120, whichever one you want to use, and the 200. And outside this trend line, if we get a confluence of price trading above those, buying into support as price comes into those on an established uptrend, that's what I'll be doing with those funds. And then and then putting stops below the swing lows that we've had coming out of this. Maybe the first major swing low that touches this trend line. We'll buy into support right above that, and then our stops will be below that swing low. Go ahead and use those funds to put on a large trade that tries to capture the meat of this move back out of this market for a couple of years. And then whenever we get detached again, like we did here, get well above these moving averages, where the moving averages are really fanning out. And a lot of our other fundamental metrics, we'll look at the Mayer multiple and reserve risk and other metrics like that, MVR, VZ score, whenever those start to show that they're heated, then I'll take my initial investment back off the table again. But this is a multi-year cycle, multi-year planning, of course. So that's my plan currently, to be fully back in this area with my current stable coins, and then to use some my initial investment in crypto funds, some outside funds anyway, we'll call it, to buy on clear resumption. Once we've clearly put in a bottom, we're back above all the major moving averages, we've established support in a new area, and I have very clear invalidation of it should it want to roll back over, that's when I'll be putting in those orders to buy back in. Okay, everybody, take care. Thank you for your time. I hope this video was useful. You can consider like and subscribe. I'll try to do more videos. I think the bear market's going to be kind of boring. Again, stay away from altcoins. But I'm not going to be doing any altcoin videos for a while. I'm going to be focused entirely on Bitcoin because if we're correct and there's a prolonged period of price weakness, altcoins are really going to get destroyed. But this is a good time for us to start really researching what projects we want to load up on here in the next 3 or 4 months. I'm doing my research now. I will start putting out altcoin videos once, basically the same time, when I see that we've cleared all those moving averages, everything I just talked about, outer trend line, moving averages. Once I'm pretty sure that we're clear and we put in the bottom, I don't know what I just did there. Once I'm pretty certain that the bottom is in, I will start then talking about which altcoins that are really good buys, but they will need to be down significantly from where they're at because we've lost momentum. All the altcoin charts that I'm looking at pretty much look pretty bad. There are a few that are holding up relative strength. Elrond and A0, which I've been talking a lot about lately, they've been showing a lot of relative strength here. So we'll start to look more of those in a few months. But thank you again. Please check out our Discord community as well. We have a pretty good group of traders in Discord. Feel free to come share your thoughts there. It's more of a community effort. It's not necessarily my Discord. I set it up out of a request by others to have a community Discord that was free for people to come and go. So check out our Discord as well. Take care.